What if I told you that the single largest wealth transfer in the history of modern capitalism is happening right now, and most people have no idea which side of it they are on? Oil has powered the global economy for over a century. Entire nations were built on it. Trillions of dollars of wealth were created from it. And in 2026, electric vehicles are not just disrupting oil demand. In a scenario that energy economists are now actively modeling, they could crash it, suddenly, faster than anyone is ready for. And when oil crashes, not gradually, not over decades, but fast, the economic consequences reach into every corner of your financial life in ways you have probably never considered. In the next 10 minutes, I am going to show you exactly how this could happen, what the historical parallels tell us, what it would do to your investments, your job, and entire economies, and precisely what you need to do with your money right now. Let me start by making sure we are all looking at the same reality, because I think a lot of people have a mental model of the energy transition that is either too optimistic or too pessimistic, and neither extreme helps you make good financial decisions. Here is where electric vehicles actually stand in 2026. Global EV sales hit approximately 18 million units in 2025, representing roughly 18 to 20% of all new vehicle sales worldwide. China alone accounts for approximately 10 million of those sales, more than half the global total. Europe is at roughly 25% EV market share for new vehicles. The United States, despite slower adoption relative to China and Europe, crossed the 10% threshold in 2025 and is accelerating. The trajectory is unmistakable. Now here is the number that matters for today's conversation. The International Energy Agency estimates that every million electric vehicles on the road displaces approximately 50,000 barrels of oil demand per day. Think about what that means. There are currently approximately 40 million EVs on the global road fleet as of 2026. That is already displacing roughly 2 million barrels of oil demand per day, every single day, that would otherwise have been consumed by gasoline and diesel engines. And that number is growing every single month as new EVs roll off production lines and onto roads around the world. So we are already in the early stages of oil demand displacement. The question is not whether EVs are affecting oil demand. They clearly are. The question, the genuinely market-shaking question, is what happens if that displacement accelerates from a gradual slope to a sudden cliff? What if the adoption curve, instead of playing out over 2 or 3 decades as most conventional energy forecasts assume, compresses into 5 to 7 years? And what triggers that kind of compression? This is where 2026 becomes a genuinely pivotal moment, because 3 things are happening simultaneously that could turn the gradual energy transition into a sudden disruption. The first is battery cost deflation. The cost of lithium-ion battery packs has fallen from approximately $1,200 per kilowatt-hour in 2010 to below $100 per kilowatt-hour in 2026 for the leading Chinese manufacturers. Below $100 per kilowatt-hour is widely considered the threshold at which EVs reach total cost of ownership parity with internal combustion engine vehicles, meaning an EV is not just better for the environment, it is cheaper to own and operate over its lifetime. When something cheaper and better is available, adoption does not grow linearly, it grows exponentially. The second factor is the emergence of Chinese EV manufacturers, BYD, CATL, NIO, Li Auto, as genuinely globally competitive producers at price points that Western markets have never seen. BYD's Seagull model sells in China for approximately $10,000. $10,000 for a fully electric vehicle. Even accounting for import tariffs and shipping costs, the economics of mass-market EV adoption at that price point fundamentally change the conversation about how quickly adoption can accelerate in price-sensitive markets across Southeast Asia, Latin America, and Africa, markets where hundreds of millions of people are making their first vehicle purchase decisions right now. The third factor is the fleet replacement dynamic in commercial transport. Long-haul trucking, last-mile delivery, municipal buses, these are not individual consumer decisions. These are fleet procurement decisions made by corporations and governments on multi-year replacement cycles. In 2026, the economics of electric commercial vehicles are crossing the break-even point in an increasing number of applications. And when a fleet operator switches, they switch their entire fleet, not one vehicle at a time. The commercial vehicle transition, when it really accelerates, will displace far more oil per vehicle than passenger car electrification. Now let me walk you through what actually happens to oil markets when demand starts falling faster than the market expected, because this is the part that most people in the energy transition conversation completely miss. They focus on the winners: EV companies, battery manufacturers, charging infrastructure providers, and yes, those are important, but the more immediate, more economically significant story is what happens to the losers. And the losers in a sudden oil demand crash are not just oil companies, they are entire countries, entire financial systems, and through those financial systems, they are you. Here is the core mechanism. Oil-producing nations have built their entire government budgets around oil revenues. Saudi Arabia needs an oil price of approximately $70 to $80 per barrel to balance its government budget in 2026. Russia needs approximately $90 to $100 per barrel to meet its fiscal commitments. Nigeria, whose government revenue is approximately 65% dependent on oil, needs prices well above $60 per barrel. Venezuela, Angola, Ecuador, these are nations where government services, social programs, subsidies, and political stability all depend directly on oil revenues remaining above certain threshold prices. Now, here's what happens if EV adoption accelerates sharply enough to push oil demand down by 5, 8, or 10 million barrels per day faster than these producing nations expected. They don't all cut production simultaneously and gracefully. They fight for market share. Because for a nation like Saudi Arabia or Russia, reducing production means reducing revenue immediately. But maintaining production in a falling demand environment means prices fall. And when prices fall below fiscal break-even levels, governments face a desperate choice: cut spending and trigger domestic unrest, or borrow and accumulate debt at an unsustainable rate. This is not theoretical. We saw a version of this dynamic play out in 2014 and 2015 when U.S. shale oil production grew dramatically, pushing global oil supply above demand. Oil prices fell from over $100 per barrel in mid-2014 to below $30 per barrel in early 2016. In those 18 months, Venezuela's economy began its catastrophic collapse. Nigeria entered recession. Russia's GDP contracted by nearly 4% in 2015. Saudi Arabia burned through its sovereign wealth fund reserves at an alarming rate. And none of those producing nations had fully recovered from that shock before the next one arrived: COVID-19. A sudden EV-driven demand crash in 2026 would be structurally different from 2014, and in many ways more severe. In 2014, the demand side of the market was still growing. The shock was a supply-side glut from U.S. shale. The recovery came when demand eventually caught up to the excess supply. In an EV-driven demand crash, the demand side is structurally declining. There is no natural recovery mechanism. The demand that is shifted to electricity does not come back to oil. Every barrel of oil displaced by an EV is permanently displaced. The market has to adjust to a new, lower level of equilibrium, and that adjustment for oil-dependent economies and oil-dependent financial systems is brutal. And here is the financial transmission that most people completely miss. Oil-producing nations finance their government spending through sovereign wealth funds, through dollar-denominated debt, and through the petrodollar system that has been the foundation of global financial architecture since the 1970s. If those nations are simultaneously facing revenue collapse and are forced to liquidate their sovereign wealth fund holdings to fund government operations, they become forced sellers of global equities, global bonds, and other financial assets. Norway's sovereign wealth fund alone holds approximately $1.7 trillion in global equities. Saudi Arabia's public investment fund holds hundreds of billions more. If these funds shift from net buyers to net sellers simultaneously, the impact on global financial markets is direct, immediate, and painful, regardless of whether you own a single share of an oil company.
Let me take you back through history, because we have been here before. Not with oil and EVs specifically, but the pattern of a dominant energy source being suddenly disrupted by a cheaper, better alternative is not new. And the historical record of what happens to the economies and investors caught on the wrong side of that transition is deeply instructive. Think about coal. For most of the 19th and early 20th century, coal was the oil of its day. It powered industry, it heated homes, it moved ships and trains. Entire cities, Pittsburgh, Birmingham, the Ruhr Valley in Germany, were built on coal. Entire political economies, entire working-class communities, entire financial empires were organized around the assumption that coal demand would continue growing indefinitely. And then, oil happened. Then, natural gas happened. Then, nuclear power happened, and coal demand in developed economies did not just slow down, it collapsed. Not evenly, not gracefully. The communities built on coal, the mining towns, the steel towns, the railroad towns, experienced economic devastation that lasted generations. The coal companies that did not diversify saw their valuations destroyed, and the investors who held those companies, who assumed that historical earnings were a reliable guide to future earnings, lost enormous amounts of wealth. Or go back even further, whale oil. Before petroleum was discovered in Pennsylvania in 1859, whale oil was the primary fuel for lamps across the Western world. The whaling industry was one of the most important industries in America. New Bedford, Massachusetts was one of the wealthiest cities in the country because of whaling. And then, Edwin Drake drilled the first commercial oil well. Within years, not decades, years, the whale oil industry had effectively collapsed. The price of whale oil crashed. The whaling ships sat idle. The wealth built on whale oil evaporated. The pattern is always the same. A new energy source emerges that is cheaper, more abundant, and more scalable than the incumbent. The incumbent defends its market position, argues that the transition will be slow, points to all the reasons the new technology is not yet ready. And then, the tipping point arrives. And when it arrives faster than anyone expected. The transition is not linear, it is exponential at the inflection point. Now, here is the crucial question for 2026. Are we approaching that inflection point for EVs and oil? The data suggests we may be closer than most conventional forecasts acknowledge. Morgan Stanley's energy research team published analysis in 2025 suggesting that peak oil demand could arrive as early as 2027 to 2028, significantly earlier than the IEA's base case scenarios. Goldman Sachs energy analysts have modeled scenarios where oil demand begins declining in absolute terms before 2030. These are not fringe views. These are the research outputs of the largest, most sophisticated financial institutions in the world. And if those scenarios are right, if peak oil demand arrives in the next 2 to 3 years and is followed by a structural decline, the financial consequences for oil-dependent assets, oil-dependent nations, and oil-dependent portfolios would be massive and irreversible. Not a temporary dip that recovers, a structural repricing that persists for decades. All right, let us talk about your money. Because if everything I have just laid out has any validity, and I believe it does, there are specific, actionable things you can do right now to position yourself on the right side of this transition rather than the wrong side. Standard disclosure first. Nothing I'm saying is personalized financial advice. I am not your financial advisor, and your specific situation requires a qualified professional. What I'm giving you is the framework that sophisticated institutional investors are using to think about this transition. Take it, research it, and make your own decisions. The first thing you need to do is honestly audit your oil exposure, both direct and indirect. Direct exposure is obvious. Do you own shares in oil companies, oil ETFs, oil futures, or anything that explicitly holds petroleum assets? But indirect exposure is more insidious. Do you own stock in airline companies? Airlines are essentially leveraged oil price plays. They benefit when oil is cheap and suffer when it's expensive. Do you own stock in traditional auto manufacturers that are behind on their EV transition? Ford, GM, Stellantis, companies that are navigating the EV shift with varying degrees of success and investment. Do you own emerging market ETFs with heavy exposure to oil-producing nations like Saudi Arabia, Russia, Nigeria, or the Gulf states? All of these represent indirect oil exposure that needs to be understood in the context of a potential structural demand shift. Second, consider the direct beneficiaries of EV adoption acceleration. This is more nuanced than simply buying EV company stocks. EV company valuations, particularly Tesla, BYD, and the Chinese EV manufacturers, already reflect significant optimism about the energy transition. You may not be buying the transition cheaply at current valuations. The more interesting opportunities may be 1 or 2 steps removed from the headline EV companies themselves. Think about the electrical grid. Every EV that goes on the road needs electricity. That electricity has to be generated, transmitted, and distributed. Electric utility companies, grid infrastructure operators, and smart grid technology providers are all positioned to benefit from EV adoption, and in many cases, they trade at more reasonable valuations than the headline EV manufacturers. Companies involved in grid modernization, the physical infrastructure of substations, transformers, transmission lines, and smart grid management software, face decades of growing demand, regardless of which specific EV company wins the vehicle competition. Third, look at the critical mineral supply chain. EVs require lithium, cobalt, nickel, manganese, and copper in quantities that dwarf what the internal combustion engine ecosystem needs. The lithium battery in a single EV contains approximately 8 kilograms of lithium, 14 kilograms of cobalt in older chemistries, and substantial quantities of nickel and manganese. Multiply those material requirements by the tens of millions of EVs being produced annually, and you have a commodity demand story that is entirely different from the oil demand story. While oil faces structural decline in an EV scenario, copper, lithium, and the battery metals face structural demand increase. Commodity ETFs focused on industrial metals or direct exposure to high-quality lithium and copper producers represent a way to play the EV transition through the resource side rather than the manufacturing side. Fourth, think carefully about what you own in fixed income as it relates to oil. Sovereign bonds from oil-dependent nations, bonds issued by Saudi Arabia, the UAE, Nigeria, Iraq, and other petrostates, carry meaningful credit risk in a scenario where oil revenues collapse faster than expected. If you own emerging market bond funds, check their country allocations. High-yield corporate bonds from oil companies, particularly smaller, higher-cost producers who need oil above $60 or $70 per barrel to remain profitable, carry the same structural risk. Investment-grade sovereign debt from nations with diversified economies and limited oil dependence is a safer destination for your fixed income allocation in an EV disruption scenario. Fifth, and this is about personal financial resilience rather than portfolio construction, think about the cost of living implications of a world where oil crashes. A sudden and sustained drop in oil prices would significantly reduce gasoline costs, reduce airline ticket prices, reduce the cost of goods with embedded transportation costs, and potentially ease grocery prices over time. For consumers, for people who spend money rather than produce oil, cheaper oil is actually a net benefit to purchasing power. The scenario we are describing is not uniformly negative for everyone. If you're an oil consumer, not an oil producer, a structural decline in oil prices improves your real standard of living. Building a budget and financial plan that can take advantage of that improved purchasing power while ensuring your investment portfolio is not concentrated in the assets that are losing value is the dual challenge of this transition moment.
Let me give you the biggest picture view of what we are actually talking about here, because I think it is important that you understand the scale of what is potentially happening. The global economy has never executed an energy transition of this speed and this scale before. Previous energy transitions, wood to coal, coal to oil, happened over generations, not decades. The infrastructure, the jobs, the financial systems, and the geopolitical arrangements built around the old energy source had time to adapt. Imperfectly, painfully, but with enough time that the adjustment was measured in generations rather than years. The EV-driven disruption of oil demand, if it accelerates as the most aggressive scenarios suggest, is happening on a timeline that the institutions built around oil, the petrostates, the oil majors, the fossil fuel financial infrastructure, have never had to navigate before. The social contract of entire nations is built on oil revenues funding government services. The sovereign wealth funds of the Gulf states are built on converting oil in the ground into financial assets above ground. The geopolitical power of Russia, Iran, Venezuela, and Nigeria in global affairs is built on oil as leverage. All of that gets repriced in an EV demand crash scenario, and the repricing is not gentle or gradual. It is abrupt, it is asymmetric, and it is irreversible in the short to medium term because the demand that has moved to electricity does not come back to oil. This is not a story with clear good guys and bad guys. The communities built on fossil fuels in Texas, in West Virginia, in Alberta, in Aberdeen, in the Permian Basin are full of real people whose livelihoods and identities are built around an industry that a structural energy transition disrupts. That human reality deserves acknowledgement. The financial and economic disruption of an energy transition is not abstract. It costs real people real things. But the direction of travel is clear. The technology is real. The economics are compelling. The capital is flowing. And in 2026, we are close enough to the potential inflection point that ignoring this risk, or this opportunity, depending on where you sit, is not a neutral decision. It is a decision to be surprised. The investors who understood the coal transition early built wealth by positioning for the new energy reality before it became obvious to everyone. The investors who held coal assets because coal had always worked found themselves holding stranded assets that never recovered their value. The same choice is available to you right now, not between optimism and pessimism about EVs, between preparation and surprise. Here's what I want you to walk away with. Electric vehicles are not just a technology story, they're a financial system story, a geopolitical story, a wealth transfer story. If EV adoption accelerates to the point where it suddenly crashes oil demand, not gradually but quickly, the consequences cascade from oil company stock prices, through petrostate fiscal crises, through sovereign wealth fund liquidations, through global financial markets, and into your portfolio. The 2014 oil price crash showed us a preview of what oil-dependent economies look like under financial stress. An EV-driven structural demand crash would be that dynamic but permanent. The response is not to bet everything on EVs. It is to audit your oil exposure, understand your indirect risks, identify the genuine transition beneficiaries, grid infrastructure, critical minerals, electrical utilities, and position your portfolio for a world where the energy landscape looks very different in 5 to 10 years than it does today. You have just done more thinking about this transition than most people with money in markets will do this year. That is genuinely valuable. Do not let it sit unused. Drop a comment below. Do you think the EV transition will crash oil demand suddenly or gradually? And are you currently positioned for either scenario in your portfolio? I read every comment, and this is exactly the kind of conversation I want to have with this community. If this video changed how you think about the energy transition and your money, hit that like button. It genuinely helps this reach more investors who need to think through these risks. Subscribe if you want to stay ahead of the macro trends that will define wealth creation and wealth destruction over the next decade. Turn on notifications. Share this with one investor in your life who is still thinking about EVs as a car story rather than a financial system story. Coming up very soon, we are going deep on what happens to the US real estate market if interest rates stay elevated through 2027. Mortgage rates, home prices, rental markets, and REITs, all of it. If you own a home, rent, or invest in real estate, that video is made for you. I'll see you there.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.